Welcome back to my channel, Survive and Thrive, where I talk about different finance options and strategies to build your path to financial freedom. Today I really wanted to focus on some thoughts I've been having over the last few weeks about different sectors related to stocks and the portfolio allocation and ways to really be able to balance your portfolio. So some of you have probably seen that there is actually an industry standard for how sectors are divided. The Global Industry Classification Standard, GICS, actually breaks it into 11 sectors. Those 11 sectors are energy, materials, industrials, consumer discretionary, consumer staples, healthcare, financials, information technology, telecommunication services, utilities, and real estate. Now that can be a lot to think about in terms of being able to balance your portfolio with stocks amongst those 11 different sectors. To simplify that, I've always thought about it in terms of 5 different sectors: finance, utilities, consumer, manufacturing, and resources. Now, due to the challenges over the past year that we've been dealing with related to global impacts, we've seen that because people are not outside of their house and spending as much money for consumer discretionary, that there's been a much larger focus on consumer staples. Now, I think most of you know what consumer staples are, but those are the goods and services that people buy out of necessity regardless of what is happening with the economy and are generally thought to be defensive. These would include companies that provide food, beverages, hygiene products, tobacco, and certain household items. As I've looked into my own portfolio, some of my larger accounts, I've noticed that I'm more focused on technology, high growth stocks, and I really need to put more of a focus on consumer staples because these are the companies that are typically long-lasting companies that have a slower growth over time but are still very stable. Now, the companies that I'll be covering today, 4 out of 5 of them I do actually have holdings in. And so I will start with the company that I have the least amount of holdings in, and that is Walmart. Walmart's a company that was founded in 1962, and they're headquartered in Arkansas. They're number 19 as far as world's largest public companies. And just to put that in perspective, Amazon is actually at number 22. With Amazon being just behind Walmart, that puts Walmart as being the world's largest retailer. Now, the positives that I see for Walmart going forward is that they've had a 79% increase in e-commerce sales in 2020. And some of you may have heard that they actually had an acquisition of a company called Flipkart, which is a direct competitor to Amazon in India. And so this has been Walmart's means to be able to compete with Amazon in India. And this acquisition happened in 2018, and they're anticipating possibly having a IPO this year. I think this is huge for Walmart because India actually is the second world's largest populous country. And so once Walmart is able to partner with Flipkart and really turn this into a strong e-commerce business, they will definitely be able to take advantage of that population and further growing their sales. I found this article on Motley Fool. Buying Walmart stock could be the smartest thing you ever do. Just wanted to talk about a few highlights. This was fairly recently, within the last few months. The company has definitely managed to be successful throughout the years. They know their customers and they change with the times. Their everyday low price effort helps to draw in more than 265 million customers every week, which is even more true during tough economic times as we continue to experience unemployment at high elevated levels. During the pandemic and resulting recession, Walmart's adjusted sales increased by 7.7% to $564.2 billion. Now, this should continue to improve as the economy improves, but even if the economy goes through another downturn, there will still be lots of people that will be shopping at Walmart and buying those items that are of necessity. So the next big reason for taking a stake in Walmart, ever higher dividends. They've managed to turn their higher profitability into greater cash flow. Last year, its free cash flow was $25.8 billion, which it used to cover the $6.1 billion of dividends and $2.6 billion of share repurchases it made. For me personally, with one of these larger portfolios I've been looking at, my share price was $150 on average that I paid in. Currently, Walmart is sitting at about $135 per share, so I'm definitely taking a hit. Within the next 12 months, I've seen some analysts on the high side say that the share price could go up to $180. And I think that right now it's probably a good time for me to take this opportunity to add to my position while it's at a good buy range and really add to my portfolio. Now jumping over to Walmart's dividend history, their dividend yield is 1.62%, which works out to be about 55 cents per share. And you can see down here the list of dates as far as when they paid out, when the ex-dividend date was, and how much the payout amount is listed at. Next, I want to talk about the number 2 holding out of my 4, and that is Costco. So for Costco, this is a company that was founded in 1983. They're the 3rd largest retailer in the world, and they have a 90% retention rate for customers. Now, a lot of their revenue is built off of memberships, and with a high retention rate, that's guaranteed money that they get year over year. I did find another article through Motley Fool specifically discussing Costco. They definitely got a big boost during the pandemic with their share price, and even from as far back as 2016 to current day, their share price has more than doubled. And even though the stock has significantly underperformed the S&P 500 since March of last year, which is a possible indicator that shareholders are worried about Costco's prospects, this definitely presents a long-term investor with an opportunity to own in a quality business. This business is still very strong. Even though Costco's second quarter 2021 earnings per share missed analyst estimates, this was driven primarily by higher gas prices. The company usually makes less on the sale of gas when this happens. However, this is an extremely volatile input, which the company has no control over and shouldn't be something that investors worry about. Revenue growth in the quarter was still robust. Comparable sales gained 13% overall, 75.8% in the e-commerce side of their business. And although February saw a deceleration in sales growth compared to January, they highlighted a strong membership renewal rate, which ended the quarter with 59.7 million membership households. With nearly all of Costco's profit coming from these fees, these 2 metrics are key for tracking the performance of the business. Even as the world slowly moves past the pandemic and returns closer to normalcy, one burgeoning part of Costco's business is showing no signs of letting up. And that's in the online same-day grocery sales, which skyrocketed 450% in the second quarter of 2021, after soaring almost 300% in the previous quarter. Also on the Costco logistics side, the in-house solution formerly known as Innovel, they continue to fulfill a greater percentage of delivery orders compared to third-party providers. This showcases Costco's adeptness at serving its customer in more convenient ways, which is something that will only grow in importance going forward. Another key point is that they have a solid long-term addition. Costco's success over time, especially during the last year, demonstrates just how powerful their competitive advantages are. The massive scale, 175 billion in sales globally in the last 12 months, allows the company to purchase goods at low cost, savings it then passes on to consumers, which won't change anytime soon. Now jumping over to Costco's dividend history, per share they're at 70 cents or 0.79% dividend yield. And what I really like about Costco's dividend history as you look through this list is that you see that they're very consistent with their payout and is increasing over time. But then you also see that on December 1st of 2020, they actually paid out at $10 per share, which was a special dividend payout. Now looking further down the list, 2017 in May, they paid out at $7 for a special dividend. And prior to that, February of 2015 was at $5 special dividend. Now that just goes to show you that Costco loves to reward their customers and their loyal stock owners. And so for me, this is definitely a company that I will continue to dollar cost average into. And when those opportunities present themselves when they dip, I will increase my portfolio and grow the amount of ownership that I have and really take advantage of this dividend payment history. Jumping over to number 3 on my list, this is one that many of you probably own, and it's one that I will continue to hold for the long term, and that's CocaCola. Now, Coca-Cola was founded in 1886, so they've been around for a very, very long time. In 1920, they went public. Now, I think many of you have seen that Coca-Cola is a very slow but stable growth over several decades. And this is one that Warren Buffett has invested in since 1988 and hasn't sold any shares. I went and I looked to see just how much Warren Buffett has made on Coca-Cola. And as we read through this article, you can see, as I mentioned, that he bought his first shares in 1988. And by the end of 1989, he had purchased a total of 23.35 million shares. In 1989, Berkshire Hathaway's book value was $4.9 billion, which meant that the Coke stock comprised more than 20% of Berkshire's net assets. Since the end of 1988, Coke stock has climbed 1,750%. So a huge gain and payoff for a very wise decision by Warren Buffett. Now I talk a lot about long-term investing, and Buffett's decision to invest in Coca-Cola is a very good example of that. Having his first shares back in 1988 and then adding large positions along the way, 1994, he brought his ownership to 100 million shares at that time. And like I mentioned, he never sold a single share. The stock has split 2 times since 1994, which would bring Berkshire's ownership to 400 million shares. The cost basis on those shares is $1.299 billion. At the current stock price of $51.71 per share, Berkshire's investment in Coke is worth $20.7 billion. That leaves an unrealized gain of $19.4 billion on that initial investment. Now, above and beyond that, like we talked about, Coca-Cola pays out dividends. And they are a dividend king, which means that they paid out for over 50 years. When you take a look at Warren Buffett's gains with dividends included, current quarterly payout of 40 cents per share with Berkshire's 400 million share holdings brings in $640 million over the next year in dividend income. Since 1995, it has earned about $7 billion in dividends. So it just goes to show you that when you really take the mindset to invest over a very long period of time, that you can make great gains, especially with a company like Coca-Cola. Now I'll jump over and I'll take a quick look at the Coca-Cola dividend history. Now, as you can see here, they've been very consistent with their payouts and increasing it over time. So now I'll jump over to number 4 in this list of stocks that I'll be talking about today, and that is Albertsons. Albertsons is a company that has tried a few times to IPO, and as of June 18th of last year, they actually did come out with their IPO. They were about $16 per share. It's the nation's second largest supermarket operator, and they have 2,252 stores in 34 states. I bought in at about $16.50 price paid for my average, and currently they're trading at $18.40. Within the next 12 months, they could be as high as $24. So with Albertsons, I will definitely continue to increase my position, as I think that they have a great future ahead of them and will continue to attract more investors, and their overall company growth as well as revenue year-over-year sales. Reading on the NASDAQ about if Albertsons is a good company or great value stock to invest in right now. There's the Zacks rating system that goes through a process of evaluating if this is a good stock to buy into. And right now there's a lot of investors that are watching ACI or Albertsons. It has a Zacks rank of number 2, which is a buy, as well as a value grade of A. Considering the strength of its earnings outlook, Albertsons sticks out as one of the market's strongest value stocks. Of these 4 stocks that I've talked about today, this is the one that I have the largest holdings in, and I will continue to buy heavy until share price gets up to about $25 per share, and then I'll tail back until I see some corrections or dips in the share valuation to be able to lower my cost basis and continue to build my position. I'll talk quickly about their dividend payout. There's not a whole lot of history at this point, but they are at a yield of 2.10%, or about 10 cents per share. Now that's definitely low compared to the other stocks that I've been talking about today, but I do continue to see that they will increase their dividend as their revenue increases, and they build a broader spectrum of investors into their company. Lastly, I wanted to talk about one that I've been looking at for a while, and that is Walgreens. During 2020, Walgreens stock has fallen by almost 30%, which is very cheap compared to its historical valuation. The major reason investors are skeptical about Walgreens is the competition, especially since Amazon has entered the prescription medical business. These concerns are real. However, the stock has been heavily punished, so there are still reasons to be positive. U.S. home delivery sales are recovering, and wholesale business continues to do well. Also, Walgreens has a company presence in China, which should be a growth driver moving forward. Given a host of positive catalysts and cheap valuation, long-term investors should definitely consider Walgreens stock as part of their portfolio. So like I said, it's one that I've been doing a lot of research on. They're the second largest pharmacy retail company behind CVS Health, and they were founded in 1901 in Chicago. They have 9,277 stores, and I could see that vaccine administration within their pharmacies increasing over the next 6 months to year and a half, which will bring in a lot more revenue for them, which will increase their growth. Walgreens is also a dividend aristocrat, and they've paid out for the last 45 years and are quickly coming upon dividend king status, which means paying out over 50 years. Now, like I said, I don't currently own a position within Walgreens. They're currently trading at $54.75 per share with a estimate within the next 12 months at the high side of $64. Their dividend is at 3.41% or 46 cents per share. So that definitely puts them in target with a company like CocaCola or Walmart in terms of how much they pay out. So that's all I had for today. But I did, like I mentioned, want to focus in on consumer staples or defensive stocks because I do think that it is important for a balanced portfolio. And within my larger portfolio, I'm only about 5 to 7% within this consumer staples sector. So it's definitely an area that I need to bolster. And I think that right now is definitely a good time to do that. While the last year, a lot of these companies made huge growth, and you can see that within their share price valuation. But it's starting to plateau a bit and cool off, which makes it a great time to jump into this sector and really increase the size of your positions at a cheaper cost basis. And like I said, the gravy on top of everything is taking advantage of those dividend payouts and reinvesting into your positions to further compound that money and build that financial wealth over time. If there's other companies out there in the consumer staples sector that you've done some research on or have taken some positions into and had success with your investment, please share those in the comments below. And as always, make it a great week. Don't just survive, thrive.